Hi, welcome back to Indian Economy Sessions. Now, in the previous session, we have discussed about what are the objectives of monetary policy. In this session, we will see types of monetary policy. Now, basically, monetary policy is of two types. So, this is types of monetary policy. So, in this, we have two things. The monetary policy, which is aimed at expanding the money flow in the market, that is expansionary policy. The policy which targets to reduce the flow of money in the economy, that is contractionary. So here we have expansionary monetary policy, and here we have the common thing in these two is the flow of money. If the flow of money is increased by taking suitable steps, if the flow of money is increased in the markets, into the system, if the money is pumped into the system or increased in the system, it is expansionary, means more money will be available for investments, more credit will be available for loans. People can take more home loans, people can take more vehicle loans, etc., 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 will take place here. So in expansionary monetary policy, the RBI tries to pump as possible as more money into the economy. Here it takes out the money from the system. So contractionary monetary policy, taking out the money from the system, and here pumping the money into the system is expansionary monetary policy. Now here pumping the money, here pulling out the money. Now how does the RBI is going to pump or pull out the money from the system? It uses basically repo rate, one of the major financial tools in the hands of central bank, that is Reserve Bank of India. For example, if the repo rate is increased, assume that this is a bank and this is containing money. Now if repo rate is increased, money flow will be towards the RBI. So the bank is supposed to pay more interest rate. More interest rate means more money goes to the Reserve Bank of India. If repo rate is decreased, so decreased means the excessive money. Initially, for example, it is used to pay 5 rupees as interest. If the interest is reduced to 1 rupee, the remaining 4 rupees will be there with the bank only. So likewise, the money is increased with the bank. If the repo rate is increased, in addition to 5 rupees, if 1 rupee is supposed to pay by the bank to the Reserve Bank of India, so the bank is supposed to pay additional amount. If the repo rate is increased, banks are supposed to pay additional amount. So money will be reduced in the banking system, that is contractionary monetary policy. If the repo rate is decreased, out of 5 rupees it is supposed to pay only 1 rupee. I am taking example only. So remaining 4 rupees will be there with the bank. So money will be increased with the bank. So in one case the money is increased in bank, in another case money is decreased with the bank. That means that money flow is increased, money flow is decreased. So increase in repo rate leads to reduction of money in the banking system, that is contractionary monetary policy, and decrease will leads to increase in the money in the bank. So expansionary, more money will be there. When more money is there in the bank, then bank puts a board like this. We are giving home loans, interest percentage reduced. We are giving vehicle loans, two-wheeler loans, four-wheeler loans. We are giving home loans, two-wheeler loans, four-wheeler loans. Those things are going to happen when more money is there in the banking system. That is possible only when RR is reduced. So that is expansionary. So this excessive money can be used for investments, industrial development, for the construction of houses, to buy two-wheelers, to buy four-wheelers. So that is expansionary monetary policy. Contractionary means money with the bank will be reduced. Expansionary means money with the bank will be increased. This excessive money with the bank results in teaser loans. Remember, teaser loans means the banks attract the people to take home loans at a low interest rate, to take vehicle loans at low interest rate, to take four-wheeler loans at low interest rate. That is teaser loans, and that is expansionary monetary policy. So in expansionary monetary policy, RR reduced. In contractionary monetary policy, RR increased. So RR increased, less money in the banking system. RR decreased, more money in the banking system. So RR decides, or RR dictates, contractionary monetary policy and expansionary monetary policy. It is the key factor actually. Now this is one thing. And one more thing about expansionary and contractionary monetary policy is buyback government securities. For example, government bonds, government securities or bonds are purchased by the people. That means that the bond will be there with the people and money will be there with the Reserve Bank, or it will be there in the system. If the government or the Reserve Bank of India buybacks, purchases them back, then money will be there with the people and bond goes back to the Reserve Bank of India. So to go for more expansionary monetary policy, one more step taken by the Reserve Bank is to buy back government securities. So first step is it focuses on repo rate. Second step is it buys back government securities. Now I'll explain in detail. For example, this is an individual. Initially in 1995 he purchased some bonds worth of 100 rupees. In 2000, after 5 years, the government is supposed to pay some interest rate on it. So this whole amount is paid by the system and it buys back these bonds in the year 2000. So in the year 1995, the money of this individual is with the Reserve Bank or the government. That means money is reduced in the system because the people are giving their money to the government. Only the bond paper will be there with the people in 1995. So 1995, as the people purchased the bonds by using their money, the money will be reduced in the markets. So that is contractionary monetary policy 1995. In the year 2000, after the maturity period is over, the government is supposed to pay 100 rupees with interest. So the money comes back to the people. So money will be increased in the markets in the year 2000. So in the year 1995, by selling bonds, they have taken the money of the people. In the year 2000, they are purchasing it back. So they are supposed to give money back to the people. So in this case, the 1995, there will be no money in the hands of the people. So it is reducing the money in the market. So it is an example for contractionary monetary policy. After the maturity period in the year 2000, money comes back to the people, more money will be there because interest is being paid. That is expansionary monetary policy. So if the RBI wants to pump money, it can reduce the repo rate. Look at this, it can decrease the repo rate. If it wants to pull out the money, it can increase the repo rate. And it can also do one more thing, it can buy back government securities. If it is selling no money in the system, that means contractionary monetary policy. If it is purchasing back, it has to pay additional money, so money will be there with the people. In this case, take 1995, people are buying the bonds, means the money of the people goes to the government, the money in the markets will be reduced, contraction in money. When money comes to the people after 5 years, that is when government buys back, purchases those bonds, that is expansionary monetary policy. So in brief, there are two types of monetary policy, expansionary monetary policy and contractionary monetary policy. Now I am giving you a question. In COVID-19 pandemic, which type of monetary policy is suitable? Whether the RBI is supposed to go for expansionary monetary policy or the RBI is supposed to go for contractionary monetary policy. Think about that one. In my next session, I will answer this one. So this is all about types of monetary policy, expansionary monetary policy and contractionary monetary policy. Uses repo rate as one instrument and government securities as another instrument. Decrease in repo rate, expansionary monetary policy. Increase in repo rate, contractionary monetary policy. Sale of government securities, contractionary monetary policy. Buyback of government securities, expansionary monetary policy. So keep an eye on this one, because with respect to COVID-19 pandemic, there is a possibility of a question on expansionary monetary policy. So that's all about this session. Thank you.